Many of you have asked what's happening with Silicon Valley Bank. I'm going to break it down for you. Silicon Valley Bank tripled its deposits from 2019 to 2021. Primarily, their depositories were venture capitalists, right, in Silicon Valley specifically, and other venture capitalists across the United States. Depositories came in, okay, many depositories. What you have to understand is that depositories are really a liability for a bank. What do I mean by that? You have to pay interest on said depositories back to your consumers or your clients. Institutions or banks also have overhead costs. They have operational costs, compliance costs, physical locations, etc., employees, and beyond. So how do banks make money is really the question that we need to answer. Banks make money on many ways, but primarily they make money on fees and loans. They create loans on the depositories. Think mortgages, that's my world. Think about consumer loans, car loans, business loans, commercial loans, industrial loans, etc. But what happens when there's more depositories than there are borrowers to give loans to? Rising interest rates. Then what the bank needs to do is they need to look at investing their depositories into the open market. They can do stocks, but mostly and primarily banks invest their money in the bond market and they start buying loans. Buying loans is in the bond market, which are treasuries, right? And mortgage-backed securities. So why bond? The reason for bonds is in 2008, the Dodd Frank Act was put into effect and allowed banks to invest in the bonds and hold those bonds to maturity, not subject to market fluctuations, which means they aren't forced to show actual real-time visibility into what those bonds are doing. They aren't forced to mark to market. Okay, so their balance sheets are really not truly accurate. And so if there is a suffering of loss in the market, they're not negatively reflecting this on their P&L or balance sheets. And the reason why these banks do this is because these bonds are guaranteed investment by the US government under the Dodd Frank Act. It all sounds good, right? Well, here's what happened with Silicon Valley Bank. You've got long-term bonds and you have short-term bonds. Okay, so think 10-year treasuries and think 20-year treasury or 2-year treasuries, excuse me. And what you have to understand is when interest rates rise, the bond market has an inverse effect. It falls. Look at my pendulum swinging here. Interest rates rise, bond market falls. Our longer-term investments, our longer-term bonds are way more volatile than my short-term bonds, short-term investments like 2-year treasuries here, right? Less fluctuation. And what this does, it creates what we call an inverted yield curve. And the inverted yield curve is really a direct sort of indicator for us that there's maybe a sickness happening in the economy. The economy is not well, so to speak. So Silicon Valley Bank and many other banks are investing in long-term bonds. The reason they're investing in the long-term bonds initially is because it's a bigger return on your investment. The longer the investment time, you would think for a greater return here. All of this is great as long as the clients don't pull the depositories out of the bank. What happened? Well, this is what happened. In February, Jim Cramer really shone a light on Silicon Valley Bank, and he said, this is a great buy. We should really be buying this stock price. Let's really dig into the stock price. And Cramer has a lot of influence. This is all politics, baby, too. So what happened then is money managers, savvy investors really started to do what I call peel back the onion. They started to peel back the onion and peel back the layers of the onion. I love onions. Onions is always an analogy I have. We're peeling it back. And as they peeled back the onion, what they really saw was a duration mismatch, i.e. mark to market, meaning these longer term investments were really performing at a major loss. Why? Because interest rates go up, bond market goes down. And when the bond market goes down, this all of a sudden becomes a major loss in real time, right? And so to the degree of which when the investors were really peeling back the onion, they started to see a $15 billion loss. $15 billion. And if you look at their assets, what that would really mean in real time is that if you looked at their balance sheets, that would really be a negative $3 billion on their balance sheets. And so there was an advisement to pull out of the bank. And they pulled out really aggressively, really fast. So Silicon Valley Bank goes out and tries to secure a loan to meet the withdrawal demands of their customers, and they were denied said loan. Remembering that all of their money is in the long-term bonds, which have fallen 10x. Okay, 10x. They've gone way, way down. And so Silicon Valley Bank can't sell its stock, right? Because the stock is in a free fall and they can't get the loan to meet the demands of the depository withdrawals. And so they're forced to start selling assets, i.e. these 10-year bonds at a major, major loss. They're selling them at a 10x loss, which results in what we call in the industry a run on the bank. And the institution completely fails. So that's what happened with Silicon Valley Bank. Last week, some individuals at a federal level said they're not going to step in and bail out, but really they have no choice. Why? Because money is FDIC insured up to $250,000. And we have to understand is there's a lot of companies that had their money held up in Silicon Valley Bank. Remember, they tripled their depositories in 2019 to 2021. And so money was locked down. And what's happening on tomorrow on March 15th is payroll demands are here. And they need to hit payroll. So the feds had nothing better to do than to step in, thankfully, to save Silicon Valley Bank. Now, if we look at the pedigree of the individuals that were running Silicon Valley Bank, presidents and some other individuals, which I'm not going to name, you can do your own research. I'll just say there might be somebody who worked at Lehman Brothers. You should go read about that resume. Look at the president. The president has been selling his stock strategically over the past year. That's fascinating. Today, the feds announced that they're going to be doing an investigation in Silicon Valley Bank, and I'm sure these executives will get scrutinized. Will this happen again? You know, banks are invested in the bond market. To me, this says that the feds, Jerome Powell and his chairman, need to not be so bullish in their language about inflation. Remember, inflation, all that inflation is too many dollars chasing too few goods. Inflation has a direct impact into the bond market and specifically to mortgage-backed securities, i.e. interest rates. We know that in the inflation numbers that are coming out in the news, there's a lag. There's a misreporting of some components. We know that shelter costs, there's a lag in shelter costs. Shelter costs are directly reported in the core consumer price index, and that's one of the Fed's North Stars in terms of how they're measuring inflation. The feds always look in the rear view mirror. There's also some false numbers, or what I call fluffified numbers, in the jobs report. So these factors are rear view mirror looking. The Fed's direct response to combating and controlling inflation is by raising the federal rate, short-term debt, car loans, student loans, credit cards, etc. Now, remember, everything's okay. At the end of the day, it's all okay. I still believe, and I sit in the seat every day, that real estate is a great place to put your money. It's a great place to invest in. Yes, interest rates are high. May 10th, mark your calendar, we're going to start to see inflation come down. There's many reasons I believe this based on economic data and information. May 10th, we're going to continue to see interest rates fall. Remember, in real estate right now, we have a severe supply and demand problem. There is not enough inventory to meet the demand of buyers who want to buy a home. If you have any questions on anything, feel free to reach out. I'm always happy to be a resource.